everybody, and welcome to all. Tom Daly here from the Academy of Financial Trading. Apologies for the slight delay in getting started, but we are about to begin your second lesson as part of your foundation trading program. A very, very warm welcome to all. This evening, what we're going to be doing is we're going to be looking at a lot of the terms which are used in financial trading, hence the title, which is leverage, margin, and all the jargon. Will hopefully be clarifying a lot of those, what some believe to be complicated terms surrounding the financial markets, and giving a full explanation as to exactly what is involved when dealing with them. As always, as we're used to, hopefully at this stage we will start out by having a look at our risk warning. It's imperative that absolutely everybody is aware of the risks associated with trading the financial markets. What we aim to do is we aim to lessen, to mitigate those risks in as far as is humanly possible. Before we get into the actual meat of this evening's class, I can see that some people are already saying hello, so hopefully the sound is coming through loud and clear, but just a very last final sound check to make sure that everybody can hear me coming through and I am not here talking to myself. Okay, great to see all the familiar names, if not the faces, back again. And again, once more, a very warm welcome to all. Many, many thanks, guys. Okay, so this evening, as I've said, we're going to go into a lot of the terms. Before we get into that, what we want to do is we want to have a quick look at the core concepts upon which we're going to build. In the first webinar, we've already covered off that the financial markets, they're like a meeting point of buyers and sellers who agree by consensus, by agreement, the current prices which exist in the market. Now we must look to some of the more important terms in order to fully understand them. And this will help us to analyze the markets correctly in order to find opportunities, as we will discuss later in this webinar series. We're going to focus upon price action based trading. We're going to find all of our opportunities based upon the actual price movement rather than the fundamental reasonings behind those movements. So let's continue on with that now. Before we get into maybe the actual terminology itself, let's have a quick recap. I promised you that I would, so let's have a quick recap as to the main asset classes which are available to trade, which anybody can trade throughout the world. The first asset class which we will look at are commodities. Now, commodities would include things like energies, like precious metals, and like soft commodities. Energies would be oil or natural gas. Precious metals, as we all know, are gold or silver or platinum. Soft commodities are anything that you can pull from the ground, that are grown, like corn, like wheat, like soybeans. Essentially, as I've said, anything which is grown rather than mined, and the commodity sector as a whole can be quite volatile. Or we can look at trading stocks, otherwise known as equities, otherwise known as shares. Examples of these include Apple or Facebook or Microsoft or Google, and these are all listed on the Nasdaq exchange in the US. I've no doubt that you are using their products right now in order to watch and listen to this presentation. Many other examples would be Coca-Cola or the Kellogg's Company or Bank of America or Ford or General Electric and so on, and they're listed on the New York Stock Exchange. Over in the UK, you've got the likes of BP or Shell or Barclays, which are listed on the London Stock Exchange. If you want to go as far as Germany, you've got the likes of Deutsche Bank, or you've got BMW, which is listed on the DAX, and so on and so forth. So you can trade individual stocks, or you can trade composites of these stocks or shares, and that's called an index, the plural of which is indices. So you can trade something like the Nasdaq as a whole, which is a composite of the top 100 technology shares. Or you can trade the S&P 500, which is the top 500 US companies. Or the Dow Jones Industrial Average, which is some of the top 30 companies in the US. It started off as industrials, but over time they're not necessarily industrial. Companies like Disney Disney and American Express and Visa, they're all listed on the Dow Jones at the moment. Or you can trade other asset classes. You can trade government bonds, as we briefly discussed during lesson 1. You can trade derivatives based on government bonds, which are basically IOUs given by governments which will pay you back your funds with some interest. And obviously, the higher the perceived risk, the higher the interest rate, or the higher the yield which you would get from these IOUs given by governments. An example that we used was between, let's say, the likes of Germany or Greece, where an interest rate on a 10-year bond in Greece might be up towards 10% or more, whereas in Germany it's probably below 1%. And that's a reflection on the relative perceived risk of those two government bonds, those two countries as a whole. But you can trade these government bonds no problem whatsoever. You will have access to them. Or indeed, the final asset class is to trade foreign currency market. And the foreign currency market is the largest market in the world. $4 trillion a day is traded on the Forex markets alone. $4 trillion. It's by far the largest financial market. And unlike other markets, the Forex market has no physical location. It has no central exchange. So you're essentially trading currencies. And this enables you to trade from practically anywhere for 24 hours a day for 5 days a week. And currency trading, it doesn't suffer from bull or bear cycles like you might see in the precious metals market or like you might see in the indexes. Indeed, the S&P 500 is a great example. From the year 2000 all the way through up to 2010, there was very little, if any, kind of a return being given from the S&P 500. But the Forex market, it is extremely liquid. It's extremely popular. And we will talk about that in greater detail throughout this webinar series as well. What it means is that there are less gaps in the market, which is very important when you're trying to mitigate against that risk, which we will discuss at a later point. So, before we actually get into the exact terminology in greater detail, let's speak about charts. Let's have a look at trading charts. What we like are these Japanese candlestick charts. You'll see on the screen in front of you now, hopefully you can see the GBP USD daily chart. It's from last year. You can see it only runs up to the 1st of July of last year. But you read this chart from left to right. Those green candlesticks represent that the price is increasing. You're going to get more US dollars for your British pound. When you see these red candlesticks, it means you're going to get less US dollars for your Great British pound. They're called candles because each of the intervals that we're looking at, it actually looks like a candle with a wick at one or at both ends. And just like in real life, where it's important to consider both time and money, a trading chart is all about time and money. If you look along the very bottom of the chart, you can see the time element. If you're looking at the vertical axis, you can see the money, the price side of things. So we're looking at the price over time. And as I've said, we're looking at this and the price can go either up or down. There are no guarantees as to what the price will do in the future. So we can see when we look at this chart is that the pound versus the dollar, it was all the way up at that 158 level at the middle point of last year. And the earlier part of that year, it was all the way down that 146 level. And I think since then, at the moment, the GBP USD, it's back down at that 146 level, isn't it? There or thereabouts, I believe, at the moment. So we have no idea as to what the price is going to do today or tomorrow. We don't waste our time trying to figure out reasons behind movements. All we do is we look at the movement itself, and then we see if that movement will allow us to take an opportunity based upon what the price has actually done in the past. That highlighted area, Matthew, you're asking what that grey line is stretching from both X's. That's simply what the price was. What the price was exactly at the time that this screenshot was taken. That's all that means. It's not significant of anything else other than the exact time or the exact price at that exact time. So these Japanese candlesticks, they're of massive interest to us because they give us a huge amount of information which you mightn't actually be aware of. So it's very important that we understand all the information which they tell us. They tell us 4 key pieces of information, and we'll go through them one by one so that we understand exactly what they mean. The first candlestick we'll look at is on that left hand side. It's a green candlestick. The green side of things, it typically means, now I suppose there is a caveat that I need to put in, and the caveat is that you can choose to have these candlesticks whichever color you wish. We'll be showing you that during lesson number 7 when we'll be going through a platform itself. However, until that time, the default setting, which we tend to go with, is that a green candlestick is an optimistic candlestick. It's a candlestick where the price has increased over time. And the red candlestick, we consider that to be the pessimistic candlestick, where the price has decreased over a set period of time. So to begin with, we'll start out by having a look at the very bottom of the body of the green candlestick. And that is the open price. That is the price which that market opened at on that particular day. And we'll imagine that it opened, for simplicity's sake, at $100. Did it stay at that $100? No. Over the course of the day, it went down to an initial low point at $80. It didn't stay down there. Why didn't it stay down there? If I'm being completely honest with you, I don't care about the reason why. All I know is that it didn't stay down there for whatever reason. Maybe there was perceived value once that particular market went down to $80, and maybe then everybody piled in and started buying it. They started buying it and they pushed the market back up above the open level all the way up to a high point. That high point, we can say, was at $200. Did the market close at that high point? No, it didn't. The reason why we know it didn't close at that high point is that this little wick was formed, and we know that the market closed at the top of the body of the candlestick itself. So the wick at the lower end of the body, it tells you what the lowest point was hit at that exact point in time. The wick at the upper end of the body shows you what the highest point was hit at that point in time. So it gives us these 4 key pieces of incredibly useful information. It's probably something which none of us had considered before unless you actually have experience in the market, but now you will see exactly what it means, which is massively important for us. So that's the green candlestick. That's the optimistic candlestick. The exact same applies on the right-hand side. The exact same applies on the right-hand side, except if you like, it's in reverse. The red candlestick is a pessimistic candlestick where the price opened on a given day at that $200 level. Perhaps there was initial optimism about what was happening, and the price went up to a high point of $220. Did it stay there? No, it didn't. Again, for whatever reason, the price fell throughout the day and it went all the way down to $100. Did it stay right down there at that low point? No, again, it didn't. It reached back up ever so slightly to close out at the end of the day at $120. But we can see that because it's a red candlestick, it automatically tells us that the price at the end of the day was much lower, or not even much lower, but was just lower than the price at the start of the day. Some people are asking if we know if it is pessimistic, if the colour's not always the same, red and green. You'll always be able to tell, I guess, as to what the price is doing based upon the latest candlestick. If you just watch any chart for even a couple of seconds, you'll see the price either rise or fall, and you'll see the colour change based upon that rise or fall. Some platforms, they default to other colours where the pessimistic side might be blue, where the optimistic side might be blue, where the pessimistic side might still be red. I know, for example, in China, red is perceived to be quite an optimistic colour for obvious reasons. The little red book, the red flag of China, they think red is a lucky colour. So in China, if anybody was ever looking at a trading platform from China, the optimistic side would be red. Okay, so there are those little nuances, but as I've said, it doesn't massively matter. All you have to be aware of is what is an optimistic, what is a pessimistic. You can decide whatever colours you wish to choose as being your optimistic, as being your pessimistic. We'll show you how to do that during lesson 7, where we look at an actual trading platform itself. So when we look at these candlestick charts, we can now see we're looking at a euro US dollar candlestick chart, and we can see it, I guess, in greater detail. You can see how obvious it is, if you like, that the price is indeed rising when we see those green candlesticks. We can also see that the price is indeed falling when we see those red candlesticks. So we're able to tell now how to interpret them. In this example, as what we tend to look at is each candlestick is worth 1 day. Each candlestick represents 24 hours of trading. It doesn't have to be like that. You have the option again to decide whatever you want your candlestick to represent. In this example, you'll see M5 beside Euro USD at the top. So it's Euro USD M5. This stands for a 5-minute candlestick chart. So each Japanese candlestick in this instance, it only stands for 5 minutes worth of time. And again, we can see this when you look down at the time element along the bottom of the chart. You can see that the entire chart is only representative of the 1st of July from mid to late afternoon, from 1400 hours in the afternoon right through to 1820 in the afternoon. That's the entirety of the chart because each candlestick is worth 5 minutes. Again, as I've said, I'll probably say it countless times, this is something which we will be taking you through in real time during lesson number 7 when we're all on a live platform together. We'll show you exactly how to make these changes, make these adjustments, make whatever edits that you wish. But what we want to do beforehand is obviously teach you the basics behind it. So it's important that we do everything, I guess, in the right order. So let's move on. Now we're going to talk about pips. And I'm not talking about fruit, but just like a piece of an apple, the smallest constituent part of an apple is its pip. And these pips are extremely important in trading. It's the lowest incremental move that a market can make. We can also call this pip a tick or a point. It's the same thing, the lowest incremental move. Pips are usually associated with foreign exchange, but they've transcended across every single market. If you're talking about shares, if you're talking about the index, if you're talking about any market at all, you can say that the smallest increment of movement is a pip. You can also call it a tick. You can also call it a point. It all means the exact same thing. In the US, you tend to talk about ticks or points. I think over in Europe, you tend to talk about pips. They all mean the same thing. It is simply the smallest movement that any market can make. So let's have a look at an example. Imagine that the euro US dollar was trading at 1.3200, and obviously we know that it's much lower than that. It's below 110, isn't it? Is it 107 or so at the moment? But let's imagine that it was trading at 1.3200, which means that 1 euro is worth $1.32. If that market moves by 1 pip, it means that it has moved from 1.3200 up to 1.3201. So that is 1 pip. It's 1/100th of 1%. It is the 4th decimal place. So 1 pip on euro USD is equal to 0.0001. Are we all okay with that? It's the smallest increment of movement that this market can make. It's on the exact same basis as a point, as a tick, as a pip. It all means the exact same thing. Now that decimalization, as far as Forex is concerned, it tends to be the norm where it is that 4th decimal place. For stocks, if you can imagine, it tends to be the norm that it is the 2nd decimal place. For other commodities, it might be different. For oil, it tends to be the 2nd decimal place. For gold, it tends to be the 2nd decimal place. For silver, it tends to be the 3rd decimal place. So it is dependent upon the actual market that you were looking at. But regardless of it, it always simply stands for the smallest increment of movement that any market can make, regardless of what it is. So let's have a look at buying. We're going to maybe take a little bit of a step back to a degree. We need a quick reminder as to what buying and selling is in the financial markets, just to make sure that we're very comfortable with it. And before I maybe move on a little bit, I can see that some people have typed in that even on the example I had shown you on the right hand side of the screen. Let's go back and have a quick look just for absolute clarity, and let's even go up and we'll have a look at the euro US dollar chart right at this level, and we can see that it is going to a 5th decimal place. Okay, I don't want to massively confuse the issue, but that 5th decimal place, it's actually a fractional pip. We ignore it, we disregard it. That 5th decimal place is not the smallest increment of move. It's a fractional pip. Believe it or not, that is a fictional number, as silly as that might sound, but I'll be going into that fractional pip, that fictional number, a little bit more during the risk element of things. The true pip location, the true smallest increment of movement for euro USD and for the vast majority of the currency markets is the 4th decimal place. Okay, we'll be coming back to that, as I've said, a little bit later on. But trust me when I say that the smallest increment of movement is that 4th decimal place. So buying in financial trading, it's quite straightforward. When you are buying, when you are going long, you believe that it's more probable that the market will rise rather than fall. It's quite straightforward. It's like buying an investment. You wouldn't buy an investment in anything if you thought it was going to fall in value. So let's take a look at some of our currency examples. I'll use for consistency. Why? Some people are asking, why are we using euro US dollar all the time? It's just for consistency's sake. Okay, it's just for consistency's sake. Don't forget that every single thing we do throughout this foundation trading program, we'll be using a lot of examples, whether it's going to be commodities or foreign exchange or indices or stocks or whatever the case may be. The methodologies which we use are applicable regardless of the market which we are looking at. But while we're going through this educational event, I guess it's important to be somewhat consistent so we don't lose too many people, I guess. Okay, so these exact same principles will apply across all asset classes. We'll look at the euro USD. In this example, it's the most heavily traded instrument in the world, and of course it's in that forex asset class. So if you're buying euro USD, we believe that you're going to get more dollars for your euro over time, so you buy euro USD. It's how many dollars I'm going to get for my euro. So the lowest incremental move in the market is 0.0001. We spoke about that a moment ago. So if the market went from 1.3500 up to 1.4000, you would have profited. So I'm going to ask you all just quite a general question here. Remember I said the lowest incremental move is 0.0001. So how many pips has it increased by? If it goes from 135 up to 140, how many pips would it have increased by? Please type it into your chat box. Brilliant stuff. Straight out of the blocks, I can see that Victoria and Francis and Edmund and Mark and Phil and a huge amount of people. Mark, you're correcting yourself. Give good stuff. 500. That's the right answer. Some people have got it wrong. That's okay. That's why we're here to learn. The easiest way to look at it is if you put 135 below the 140, take one away from the other, and you get 500. But it's basically 500 of those lowest incremental moves, which is 0.0001. So it's moved 500 pips. Okay, I haven't spoken about what those pips are worth yet. We'll speak about that in a moment. So you can see that that's quite a large movement in price, and that can take days, that can take weeks, that can take months, that could even take years to be achieved. And if I was to say to you that after all of the training that we are going to do here, and all of the work that you're going to put in, that you would make a whopping 5 cents over that period of time, you wouldn't be too excited. But this evening's session is going to show you how such a price movement can justify our time and effort by trading with higher amounts of money using leverage very carefully, which we will speak about later this evening. So let's take a negative scenario here, because you're going to have trades that are going to work out as you expected in your favor, and you're going to have many trades which work out against you. So let's say instead of the market going up from 135 up to 140, as you had hoped, let's imagine that you speculated it would go up. Instead, it goes in the opposite direction. So it goes from 135 all the way down to 130. So instead of making money, you're going to lose money in this scenario. It's going to go, instead of going up by 500 pips, it goes down by 500 pips. Okay? So Morris, absolutely, you're saying that you have lost 5 cents. So what we're saying here is that if you were only trading €1 worth of dollars, well, you're only going to lose 5 cents over a very long period of time, which isn't very exciting. So you're probably going to have to trade larger amounts in order to justify your time. So we will come back to this. Okay, so that's buying out of the way. We've spoken about the buying element of things. Everybody grasps the buying side very, very quickly, very, very easily. We all know that the idea is that you buy low and you sell high. There's no confusion there, I would hope. Now, this selling side of things, this tends to raise quite a bit of confusion, which is why we have a picture of that confused bear on that bottom left-hand side of the market. So just like you can buy in the market, you can also sell in the market, and this is called short selling. It may seem like a bit of an alien topic to people who haven't traded before, but what we're going to do now is we're going to explain it. You're basically speculating that the price will fall in value. That's all you're doing. You're speculating that the price will fall in value. You're selling something without first acquiring it. And I guess that's the part that confuses people in the main. You're selling something without first acquiring it. But all it is the flip side of buying. The best way I think I can explain it, or one of the ways I can explain it, is that if we go back to the buying side, and if I was to say to you that you bought gold at $1,000 an ounce and you sold gold at $1,200 an ounce, that would mean that you made $200 an ounce profit. And everybody gets that, that's no problem. But when you bought that gold at $1,000 an ounce, did you actually expect the physical gold to be sent to you, appear through your letterbox, and for you to be able to hold that gold until you decided to sell it, and when you did decide to sell it, that you would have to send that physical gold back somewhere else in order to realize the gain. We know that the markets don't really work like that. What you're doing is you're not buying the physical asset. What you're doing is you're speculating on the price movement. So if you buy gold, you're assuming that it's going to go up in value. If you sell gold, you're assuming that it's going to go down in value. So maybe that answers your question to a degree, Frank. You're asking, why would you buy something that is going to go down in value? You're not buying something if you believe it's going to go down in value. You're selling something if you believe it's going to go down in value. Let's go through a bit of a working example, okay? So imagine you believe that euro dollar is going to fall. Imagine you believe that you're going to get less dollars for your euro at some point in the future. And naturally you're saying that selling is an assumption, absolutely, but so is buying. Okay? But you're selling euro US dollar because you believe you're going to get less dollars for your €1 in the future. So imagine you sell at 135. You're selling because you believe that the market is going to fall. You're speculating on a downward movement. Okay, so what you are then hoping is that it will indeed fall. So the market works in your favor. It does go down to 130. Just like the earlier example, in this instance, you have made 500 pips. You have made 5 cents. And again, I have this reminder, this strong reminder right down at the bottom of the screen. Remember, you're not taking physical ownership of anything. All you are doing is you are speculating that the price will fall, and you're then hoping to profit in the difference. Okay? And again, this is an example that has worked in your favor. You sold at a high point, you bought back at a low point. Just like that market working in your favor, it can also work against you. What would happen if you sold at 135 and the market moved against you? Imagine the market moved up to 140. In this instance, the trade would not have worked out as you had hoped. It has worked out against you, and you would have lost 500 of those pips. You would have lost 500 of the smallest increment of move. You would have lost 5 US cents in this example. Does everybody grasp this concept of short selling? If you don't, please type in N or no, and I'll try to go through a different kind of analogy maybe to try to explain things. Let me have a look. Are there many no's coming in? There are a few no's coming in. That's okay. I don't mind a few no's. It means that we're here to learn. It means we have to do a little bit better, I suppose, from our end. Okay, let me explain it a little bit better, okay? And hopefully those who do get it, if you wouldn't mind just having a bit of patience for maybe 30 seconds or so. But imagine I'm in the car business, okay, and what I'm doing is imagine I'm meeting a friend of mine for coffee, all right, and that friend of mine says that they wish to buy a car, and they tell me the make, the model, the year, the styling, if you like, and they give me their budget, and they say, look, I want to buy. Imagine they say I want to buy a Ford Mondeo. 2012 2-litre diesel with this spec, and I've got €20,000. Okay, so they've given me all the details I need to know. So I sell them. I say, you know what, I'm in the car business. I don't have one now, but I'll sell you one. I'll sell you a Mondeo for €20,000. I've just sold them something I don't have. Now, how would I, as a car dealer, profit from that transaction? I've short sold them a Ford Mondeo. How would I profit from that transaction? How would I physically profit from that transaction? Tell me what you think. Bob, you have it exactly right. Robert, you have it exactly right. You buy one for less than what you've sold it for. So you hope to go out and source a Mondeo for less than 20 grand. Okay, now how would I lose money in that scenario? How would I lose money? I've sold at a high point, I buy at a low point. I make money. Just like in trading, if I short sell in trading, I sell at a high point, I buy back at a low point, I make some money. If I'm to lose money, it means I can't find one for 20,000. I can't find one for 19,000. I can't find one for anything below 20,000. Imagine the only one I can find costs me 25,000. That means that I've just lost 5,000. Okay, so the market hasn't worked out in my favor. So, if there is a point that we're sticking on, try to relate it back to something that you might have a little bit more familiarity with. Okay, so hopefully that makes a little bit more sense now. It's no different than how the markets work. You're speculating on the price rising or you're speculating on the price falling. That is all that it is. So we've spoken a bit about buying and selling in the financial markets. And we're going to be obviously speaking about it a lot more as we progress throughout this webinar series. But now we got to move on and we're going to speak about lots. Okay, we're going to talk about standard contract sizes. When we are trading, historically, Forex and pretty much any commodity as a whole, they were traded in standard contract sizes known as lots. Okay, so a standard lot, let's say in a foreign exchange market, would be 100,000 of that currency. So if you were to buy one standard lot of euro US dollar, you would be buying 100,000 euros worth of dollars. It's a substantial trade. If you were trading gold, to trade one standard lot is to trade 100 ounces of gold, which again is quite a substantial trade size. It's out of the reach of most people. However, it's not the lowest amount that you can trade. You can trade a lesser amount. You can trade a mini lot, which is 0.1 of one standard lot, and that's to trade 10 ounces of gold. You can go lower again. You can trade one micro lot, which is 0.01 of a standard contract size, and that is to trade 1 ounce of gold. So if you imagine gold being traded, just for simplicity's sake, at $1,000 per ounce, to trade 100 ounces at $1,000 an ounce, it's a lot of money, isn't it? It's $100,000 worth of a trade. But if you're able to trade just 1 ounce of gold, it means that you're able to trade just $1,000 worth. So it makes these markets more accessible to the normal trader. And that's how we're able to get access to them, by being able to trade these fractions, if you like, of these larger trade sizes, of these larger market sizes. It's very easy to change the lot size within the trading platform itself, and again we'll be taking you through this throughout lesson number 7. You simply change the number in that volume box when you're placing the order. If you put that number 1 in, you're trading 100 ounces. If you put 0.1 in, you're trading 10 ounces. And if you put 0.01 in, you're now trading with 1 ounce. So again, it's reasonably straightforward, and it makes you determine your ideal size of the trade dependent upon the amount of capital that you are trading with. So we spoke earlier on about buying and selling, and we spoke about trading with €1 worth of dollars, and we spoke about making or losing 500 pips, and we spoke about those 500 pips being representative of 5 US cents. And we spoke about a movement like that perhaps taking days, perhaps taking weeks, perhaps even in some cases taking years to achieve. And we also said that that wasn't really worth our while, wasn't really worth the dedication that you would need in order to be able to achieve any result. If I was paid 5 cents for a week of my time, I wouldn't be massively impressed by it. How you are able to make trading worth your while is through a combination of leverage and margin. Both are intertwined. People talk about a high rate of leverage being dangerous, and it's true that it can be dangerous to those who know nothing about it. But we need to understand them in order to be able to utilize them, in order to make trading not only accessible to the average trader, but to make the outcome of successful trading very worthwhile. A quite standard rate of leverage is something to the order of 50 to 1. And that means that a broker will allow you to access a market of 1/50th of the actual price of trading. They don't do this for nothing. The reason why they do it is simply to make trading as accessible as possible. They need to make trading as accessible as possible because if they don't, it remains an elitist activity. If they make it more accessible to the common man, it means that more people will trade. It means they will increase their transactional costs, obviously, from the amount of people trading, and they will be more, or woman, absolutely, excuse me, and they will then become, obviously, a more successful company. They don't do this for free. They don't do this for nothing. In order to give you access to the market, they will require you to make a deposit. The deposit which they will ask of you is known as the margin. It's basically collateral, it's security, and it's typically seen as a percentage figure, And in this instance, it's easily worked out. If the rate of leverage is 50 to 1, you just divide 1 by 50, you get 0.02. So that tells you that the collateral required is 2% of the value of the trade itself. Okay, so they're only going to ask you to place, Siobhan, they being the broker, if you are anyway interested in trading the financial markets, you have to use a broker in order to gain access to those financial markets. It's this broker, excuse me for not being clear, Siobhan, it's this broker who is going to ask you to place this deposit with them in order to be able to access the markets, in order for you to be able to trade. We'll go through a couple of quick examples just so we can really, I suppose, hammer this point home and also explain that for the bad name that leverage has, and it has a bad name because people use it without really understanding it, that it is there to really to benefit you. It is there. It is a bit of a flip side, as I've said, but it is there to make those markets as accessible as possible. So imagine that you wanted to trade one lot of gold. And imagine, like I've said already, if the price of gold in this instance, imagine it was $1,100 per ounce. And that's pretty much actually bang on, I believe, with where it is at the moment. So if it was trading at $1,100 per ounce and you were to trade 100 ounces, if you wanted to trade the physical metal, the physical asset that is gold, you would have to put down $110,000. And that money, that's what is required just to trade one market. Just one market, okay? So it's an incredible amount of capital that you would need to have in advance in order to trade just 100 ounces of gold. The reason why you would have to trade such a large amount of capital is because the movements, the intraday movements are so small that it's only by trading these larger amounts does it justify the time and effort that we spend doing it. Okay? But imagine if the broker said to you, okay, look, I'll allow you to trade that size of a trade, but I'm not going to ask you for $110,000. Imagine they said instead that they only wanted 2%, of that $110,000. So they would only look for you to place on deposit with them $2,200 in order to trade $110,000 of gold. Does that make sense? Do you understand how that rate of leverage gives you access to a substantial trade? Okay? Are we okay with that? Might sound risky, Simon, but that's where the risk management comes into effect. You're not risking 110,000. You're still only risking 2,200. So you're not risking any more than what you have put down, but you have access to that larger trade size. The broker gains because the broker still will charge you a transactional cost. We'll go through that in a very, very short time. Don't worry too much about it. Okay, so let's have a look at if leverage wasn't available to us. Let's have a look at this. Let's imagine you had $5,000 set aside that you wanted to start trading with. Okay, that's what you had set aside. You had $5,000. You say, okay, I want to start trading. I want to go online. I want to start trading. But imagine there was no leverage available to you. Okay, and imagine that gold was trading at $1,100 per ounce. That would get you 4.545454 ounces of gold. So now you have that physical amount of gold. Okay, now imagine then that gold rose. It went in your favor. You've bought it. You're hoping that it will rise. It does rise. It goes up by $50 per ounce. How much do you make? How much do you make? How much do you make if you started out at $5,000? If you bought $5,000 worth of gold, which is 4.545454 ounces, and gold went up by $50 an ounce, how much would you make? So you would end up with $5,227.27. So your profit would be $227.27. That's what you would make. Okay? Are we all okay with that? All clear. So after all that time, after a $50 movement in the price of gold, you have come out with $227.27 profit for an initial outlay of your $5,000, your hard-earned capital, your $5,000. That's trading without leverage. Now let's have a look at trading with leverage. Imagine the rate of leverage is 50 to 1. Okay? You could trade 100 ounces with just that deposit of 2,200. Okay, you could trade $100. So you're not even using your full 5,000. You're only using 2,200 of your $5,000. Okay, you now have access to 100 ounces. So you have access to $110,000 worth of gold. And imagine again, gold just went up by $50. How much would you make in this instance? What do we think? How much would you make in this instance? You're not trading with $5,000 worth of gold. You're trading with $110,000 worth of gold. Gold has gone up by $50 an ounce. Let's have a look. It's gone up from $110,000 up to $115,000. You've made $5,000 in profit because you had access to leverage, because the broker didn't demand that you deposit with them the full amount as to what the trade was actually worth. Does that make sense? Are we all okay with that? That's what makes trading not only accessible, but that's what makes trading lucrative for most people. The reasons behind the leverage, as I've said, not only does it lower the cost, it allows us to use less capital. It also increases the amount that we have access to. It increases the amount that we have access to. So it's to do with our trade size. Without that leverage, you'd only be able to trade quite small amounts. Without leverage, you'd only be able to trade $5,000 worth of gold. Okay? With leverage, you're able to trade a lot more. All right? Not everybody, a lot of people are asking, well, what if the trade goes against you? What happens if it falls in price? Would I lose more than my deposit? You should never lose more than your deposit. You should always have a full and complete risk management strategy in place, which we will be going through with you during lesson number 9 in particular. So hang around for that. We can't cover everything in one class, so it's important that we stay around for that. The risk side of trading, the risk management side of trading, I believe, is the most important part of trading. Manage your risk, manage your exposure, and everything else will be fine. Everything else will be fine. So we'll be covering that. Don't worry. We need to explain what leverage is. That's what we're doing this evening. Not only does leverage lower the cost, not only does it give you access to a larger trade size, but it also allows you to be diverse. Okay, it also allows you to be diverse, which we all know from growing up. It's best not to keep all your eggs in one basket. It's best to spread it around. It's best to spread it around. So it's good to be diverse. It's good not to have your entire holdings in gold. We then need to go on. We need to talk about the bad side of trading. We need to talk about what happens if there is a margin call. A margin call is when the broker actually rings you up and says, look, your trade is going badly. You deposited $2,200 with us. You have access to $110,000 of gold. The price has moved against you. You know your $2,200 deposit is now in danger. Okay, so if it goes down to typically 90% of your deposit, if your 2,200 has gone down, so all you've left on deposit with your broker is, for example, $200, your broker will ring you up and say, you know what, you've only $200 on deposit with us left. We don't have the confidence that the market is going to turn around. If you want to keep the market open, if you want to keep your position open, you need to deposit more funds. Okay? In olden days, that's what would happen. The broker would literally phone you up and say that. Nowadays, because everything is online and everything is even more instant as far as emails are concerned, they don't even call you up anymore. They typically just pop you through an email and say, if you don't deposit more funds into your account, we're going to be forced to shut your position. And that's where the losing more than your initial deposit can come into effect. Okay, so if you have deposited 2,200 with your broker, if that 2,200 is being eaten into slowly but surely by the market moving against you, by the market not moving in your favor, once that begins to approach zero, the broker will phone you and say, we're either going to close your position or you got to deposit more funds. Now, what do you think you should do in that instance? What do you think you should do in that instance? The broker calls you, said, your 2,200, it's approaching zero. Please deposit more to keep the position open or close the position. What should you do? Great stuff. A lot of sensible people on this course from what I can see. A lot of people saying close the position. You're dead right. A common mistake that a lot of traders make is when they get that kind of call from the broker, they say, no, keep the position open. I'll give you more money. I'll give you more money. I'll give you more money. That's the wrong decision to take. If you put more money in it, it means that you're standing in front of a moving train. You're standing in front of a train that is hurtling down the tracks towards you and expected to stop and move back in the opposite direction. It rarely, if ever, happens. If a market is going against you to such a degree, you need to just go, you know what? I got it wrong. Get out. More importantly, you should never allow that to happen to you in the first place. Our risk management approach would ensure that that never happens to you. You would have exited the trade much sooner. Okay, so these transactional costs, again, while I was going through that leverage, that margin scenario, a lot of people were asking about the cost of trading. How much would the broker charge you? This is where the broker makes their money typically. Okay, so imagine again we wanted to trade that 100 ounces of gold. Imagine the market moves to $1,150. This $50 move has given us a profit of €5,000. We need to know how much it's actually going to cost us. What will happen in any market, regardless of what it is that the broker will charge you a number of pips for the transaction, a number of those smallest increments of movement. So imagine if it was gold, imagine the broker has a set fee of 50 pips for the gold market. And imagine that that would then be 0.50 per your trade size per trade. Okay, so it would be 100 ounces multiplied by 0.50, and that equals to $50. So for that 5,000 profit which you might have made, the broker will simply charge you a set amount of pips. If it was 50 pips as far as gold is concerned, it would mean it would be the equivalent of $50. So a $5,000 profit for a charge of $50, that's all right. Mark, you're asking what if there was a loss? If it was a loss, the charge would be the same. The charge is taken out as soon as you enter the trade. The charge is taken as soon as you enter the trade. So if it was gold that you were trading, as soon as you clicked either buy or sell, you're automatically down. Let's say if it was this trade size, it's not going to be the same for every single trade. If it was 100 ounces you were trading, you would automatically be down $50. The transaction comes out immediately. Now again, you might think that's a high charge. It's a high charge because you're trading $100 or 100 ounces. If you're only trading 10 ounces, that charge would be $5. If you're only trading 1 ounce, that charge would be 50 cents. Okay, so it's proportional to the trade size. It's not a 1%. It's not a standard 1%, Mike, or anybody else who said it. Stefan, a few more people have asked about it being a percentage charge. It's not a percentage fee. In this instance, it just happens to be that it is. It's a number of pips that they charge you, a number of pips. And it is, because it is a number of pips, it is completely proportional to the trade size. Completely proportional. All of these examples, all of these explanations, they're applicable to every single asset class. Whether it's the forex market, the commodity market, the stock market themselves, the equity markets, the indices, the bonds, no matter what it is, they're all applicable. So, is the spread a barrier to trading? It can be. And it can be because most people, they target too small a profit. A common mistake in trading is that you close your winners early and you let your losers run. Imagine in this gold scenario, imagine if your profit target was 100 pips and the spread is set at that 50 pip level. That means that if you're only targeting 100 pips of profit, your transactional costs are actually 50% of your profit target. So it's a high cost in that instance. The spread is this transactional charge. It's the cost of doing business. Okay, so now let's imagine if your profit target was higher. Instead of it being 100 pips, your profit target was 1,000 pips. The cost of doing business remains the same, like I've said. It doesn't vary. The broker is still going to just charge you a set amount of pips. But if your profit target was 1,000 pips instead of 100 pips, it's now saying that the cost of doing business is only 5% of your profit target. Okay, so that's what we prefer to do. We prefer to have a higher profit target in order to have a lower proportional cost. And this is something that you'll see in action really next week when we go onto the platform itself, where we talk about our trading methodologies, when we look at things from that technical perspective. There are one or two more quick examples or quick terms which I want to go through before we finish up this evening. Apologies for starting a little bit late. It means that we're going to go to maybe 5 past the hour there or thereabouts, but we will get there. The stop loss. This is where the risk side of things comes into play. Okay, the stop loss is your protection. Nobody should ever enter a trade without having a stop loss in place. What it is it is a predetermined exit point where you have decided that you want to exit because a trade has not worked out in your favor. Okay? Just because you never want the market to go against you, just because you never want to lose money, it doesn't mean that it won't happen. The chances of you losing money are at least 50%. So when we go into it with that realization, we need to ensure that we always use a stop loss in order to minimize our losses, to cap our losses at a level that we are very comfortable with. Okay, so that's massively important in trading. It's one of the, in our opinion, it's one of the fundamental parts of trading which everybody should look at and take in and understand completely. Okay, Johan, we prefer to talk about stop loss levels in percentage senses, but we will be going through stop losses, the calculations where we feel is appropriate for a stop loss to be placed, and all that in that completely dedicated risk class, which is lesson number 9, if you don't mind. Okay, so we'll use this example. Imagine you bought euro US dollar at 132. We've said to ourselves that, okay, if it goes down by 100 pips, I want out. If it moves against me by 100 pips, I want out. It's as simple as that. Imagine we had entered at a trade size where we were buying 10,000 euros worth of dollars. That would mean that 100 pips was the equivalent of $100. So we're willing to risk $100. We're willing for the market to move against us by 100 pips, which is the equivalent of $100 in monetary sense, in monetary terms, before we say to ourselves, you know what, I want out. Okay, so it's important for us to always be aware of that. Massively, massively important. You should always be sensible when it comes to the risk side of things. When you mind the pennies in trading, the pounds will take care of themselves. Too many people are concerned about the profits that are likely to be made. You never ever look at trading like that. It's more important to be concerned about protecting the capital which you already have. As it says at the bottom of the page, ignorance is no defense. Ever, ever, ever. Just because you didn't know is no defense. I'll say it again. Every single time you enter a trade, it's imperative that you have a predetermined stop loss in mind. That's, if you like, the protective side of things as far as the risk is concerned. We also have protection in place for when you make a profit. There's a good and a bad side to this. The good side is that it assures you of profit when a market does move in your favor. The bad side is that it limits your profit. Okay, it's called a limit order. It limits the amount of money that you make. Okay, so if again you bought at 132 as far as Euro USD was concerned, you might say that if it does move in my favor to 133, I want out. I want to realize my profit. So you can place your limit order at any level that you wish. Okay, again, you can place it. In this instance, we have a trade size of 10,000. We've placed it 100 pips above our entry. So it means that we would have realized a profit and automatically exited the market if we have made $100. And these stop losses, these limit orders, they're all automatic. You place them at the time of placing the trade. It's not as if you need to be in front of your computer at all times in order to watch a market move against you or watch a market move in your favor. You simply place your trade at the same time you place your stop loss and your limit order, or one or the other, whatever the case may be, and then you can shut down your computer and you can walk away. Because as soon as the market moves to one level or the other, it will automatically close the position for you, and thereby, if the market has moved against you, you will realize your loss, which has been minimized because you've had the sense to place the stop loss order, or it will realize the profit for you, which again is fine because you've assured yourself of a profit. You can edit them as often as you wish. There is no charge at all for placing these orders. So there is absolutely no justification in any instance for anybody if they ever do decide to not place those orders. There is never an excuse. You can never say that it cost me to place them. I didn't want to have the cost, so I decided not to. So, a quick summary. We've gone through quite a lot, and I guess I'm sympathetic to that. It's a huge amount of information to take in. Not only is it a huge amount of information, but I'm mindful of the fact that this is a class where we tend to lose people because they feel that, oh, I didn't grasp that, or I didn't grasp this, or I'm not really understanding what Tom is saying there. I will say to you now, don't worry about anything which you didn't understand. Okay, don't worry about it. Reason being, we're only on class number 2. We're going to be coming back to these terms time and time again. The good thing from this point is when we return to these terms time and time again, we will no longer be returning to them in this theoretical sense. We will only be returning to them in a more practical sense. We will be looking at charts. We will be looking at platforms. We will be looking at markets. We will be looking at price action in action and seeing exactly how to align these terms or to marry these terms together with what we are seeing. Okay? So that's what we're going to be looking at. What we have covered this evening is obviously Japanese candlesticks, pips, pip value. We've covered buying, we've covered selling, we've covered lots, we've covered the trade size, we've covered leverage, we've covered margin, we've covered use margin, spread, stop loss, limit orders. A huge amount of detail has been gone through. A couple of people are asking about the slides. Yeah, we've had an internal discussion about them. I can promise you that by next week, by the time your next live class takes place, we will have a solution in place in order for you to be able to gain access to the charts or to the PowerPoint, the actual presentation itself. We'll come up with something to make them available to you. So do make sure to stay around for that. Come back for next week, and we'll have that solution in place. What I want to do again, as I said at the end of lesson 1, is I want to show you a chart this evening. I want you to have a look at a chart And with the limited knowledge, with the limited experience that we've gone through up to this point, please do tell me what you think is likely to happen. This is a historical chart. So I want you to have a look at it, and then maybe by the week after next, when we're actually on a live platform ourselves, when we're on our practice trading accounts, you'll be able to look up and see exactly what has happened in this chart since this snapshot was taken. But this is the S&P 500. Okay, this is reading from the 2nd of March last year right up to the 1st of July of last year. I want to point out a couple of things. The couple of things I want to point out are exactly what we are going to be going through next week. We can see that there are a number of points where the market has hit almost exactly as it was moving ever so slightly upwards. Okay, there was a clear trend upwards. We can also see right across the top that there was a clear band, a clear zone, a clear area where it was never able to overcome. It kept going up and hitting it and come back down, go up and hit it and come back down. These areas, they're not arbitrary, they're not in any way random. And we use these areas, we use these areas of interest in order for us to find opportunity. We can see that most recently on this chart, over at the end of June, the beginning of July, we can see that that uptrend, if you like, did break. Okay, and we need to understand whether or not that was significant. Okay, and that's what we will be looking at next week. We'll be looking at charts just like this. We'll be looking for areas of significance. We'll be looking for areas of potential opportunity. And that to us is what makes trading so exciting. That's what we enjoy about trading. That's what we enjoy teaching about trading. It's about looking for opportunities like this and then understanding how to take advantage of these types of opportunities. James, you're asking why is there a gap? Brilliant question, James. If you don't mind, what we'll do is we'll actually cover it next week. So this has been, I guess, really the final webinar where we're focused upon more the theory side of things than the actual practical side of things. From here on, it will become a lot less theoretical. It will become a lot more practical. Don't forget that this class, as every single class, it is being recorded, and we'll make this recording available to you within the next 14-15 hours, there or thereabouts. Don't forget next week we are going to be continuing on with that technical analysis side of things. Massively important. It's the part that I am, I guess, keenest on. It's where I get really, I suppose, excited about my trading when I'm looking at things from a technical perspective. What I'd like to do now is I'd like to take, I guess, that 30-second break. I'll do a bit of gargling. I'll see if my voice is able to come back for a few more minutes after my 30 seconds. For any questions that remain outstanding, please do type them into your chat box now. I'll come back, I'll spend some time going through them, and we'll hopefully make sure that everybody is happy with what we have gone through this evening. So give me 30 seconds, guys. Type in any questions. I'll be back as quick as I can. Many thanks. Okay, guys, let me have a quick look. Let me have a look. Marcus, you're asking if it's better. Let me have a look. Excuse me. Is it better to have a bigger or smaller pip in the market you're looking to invest in? Not really sure what you mean there, Marcus. The pip is the smallest increment of move in any market. So, if you're looking at stocks, it's going to be the second decimal place. If you're looking at gold, like we used a couple of examples, it's going to be the second decimal place. If you're looking at most of them, the main, I guess, or the most popular foreign exchange markets, is going to be the fourth decimal place. So it depends on the market, and it doesn't really have any bearing, or it's not really a calculation, if you like, that you would use from a risk perspective or anything like that. But we'll do our best to help out, I suppose. It does get a little bit easier as far as explanations are concerned, I feel, when we continue on with the more practical side of things from next week onwards, if that's okay. Hyan, you're asking, in Japanese candlestick charts, some of the candles are quite long and some are so short. Why? It just means that there was some big movements some days and some small movements other days, Hyan. Again, if we use a gold market, maybe gold might only rise $10 per day, but it might rise $50 tomorrow. If it has only rose $10 today, the candlestick will be relatively small. If it rises $50 tomorrow, the candlestick will be quite large. And again, by seeing those in candlestick form, by seeing a large movement, because there is a large candlestick, it's automatically drawing your attention to maybe a little bit of extreme price action, which again is important for you to recognize, for you to understand, and maybe then for you to take advantage of, or something along those lines. Let me have a look. Let me have a look. Johan, you're saying with the example of 50 pips of a cost ratio of 10 to 1, so 10 to 5% in costs to the profit. The transactional costs, I think, Johan, is what you're referring to there. If the broker is charging you, again, if we imagine in the gold market, 50 pips in order to access the market, that's going to be the charge regardless of the profit which you are intending to make. So if you're focused upon a profit target of 100 pips, if you imagine, 50 of those pips are going to be transactional costs, whereas we would prefer to be targeting something like 1,000 pips or 2,000 pips or 3,000 pips profit, thereby making that transactional cost a smaller percentage of the overall trade. That's kind of what I'm getting at there. But again, it's something hopefully will make a little bit more sense when we progress. Kirsten, apologies, there was a mix-up in timings. No trouble, you'll be able to catch up, absolutely. You'll be able to access the recordings. They're going to be available to you, no trouble whatsoever. Some people asking about lesson number 3, which is our on-demand. Lesson number 3 will be available within your members login area this coming Saturday, I believe. This coming Saturday, early in the morning, it'll be available within your members login area. The reason why lesson 3 is the only on demand, it's the only, if you like, pre-recorded class, is because it deals entirely with fundamental analysis. Fundamental analysis is fine, it has its place, it's important that you understand it, but it's not really relevant to trading. Okay, it's not really relative to trading. What we feel is more relative to trading, infinitely more relative to trading, is technical analysis. So that's where we spend from here on in the vast majority of our time. So we will be, and I know I'm going to get the question next week, but we will be going, if you like, from lesson 2 today to lesson 4 at the start of next week. And I know when we start lesson 4 next week, a lot of people are going to be saying, what happened to lesson 3? So lesson 3 is the only pre-recorded one. It will be available on Saturday in your members login area. Please do look at it in your own time, no problem whatsoever. Tyler, you're asking, why do some stock trading platforms not include shorting? There might be some markets which you're just not able to short. You're just not able to sell for whatever reason, Tyler. But to be honest with you, as far as trading is concerned, there isn't too many markets like that. There certainly isn't too many platforms like that. So if you are actually trading, if you're trading Forex, if you're trading the stocks, the shares, the indices, the commodities, whatever the case may be, then you can indeed short the market. And again, we'll be going through this with you in a lot more detail as we progress. Let me have a guess. Sushma, excuse me, you're saying in the example of $110,000 worth of gold trade at at $1,100 per ounce, if you use leverage or a broker, we are only supposed to deposit 2,200. That's fair enough. Does that mean that the broker lends all 110,000 of the money we'd like to trade? What is their gain in that lend? Yeah, a lot of people say that that's what happens, but it's not. It's not. Sushma, excuse me, Sushma. But it's not. The broker isn't lending you anything. The broker it doesn't provide you with credit. Okay, it just gives you access to that amount. It gives you access to a larger trade size. What is their gain? Their gain is simply the transactional cost. If they didn't allow you to access that trade size, if they didn't say to you that you could access $110,000 worth of gold for 2,200, if they did say to you that you needed $110,000 up front in order to access $110,000 worth of gold, you simply wouldn't be able to trade, and nor would the vast amount of people on this course or beyond. The vast amount of the population of the planet wouldn't be able to trade if they said that you had to deposit the full amount of what the trade was valued at. So it's limiting their own revenue generation, isn't it? If they allow you to place on deposit a lower amount and give you access to trade the higher figure, more people will trade. They will generate more revenue because of that larger number of traders. So hopefully that makes sense. Let me have a look. Adam, you're asking which are the better brokers or what do we look for in order to avoid conflicts of interest? Will we cover this? Yeah, Adam, we absolutely will cover this. Again, we're going to be covering quite a lot, obviously, throughout this course. A lot of the questions that are coming in will be covered through the risk side of things because I guess that trading, it does carry that inherent risk. Risk, it's a word that is often shied away from as far as trading is concerned. In a lot of educational providers, they tend to shy away from it because they feel it's going to scare you guys away. We like talking about risk. We like explaining risk because without risk, you cannot have reward. So we think it's a massively important part of trading. It's so important that we dedicate a full hour to it. So, Christian, you're saying for a broker it's a win-win situation whether you win or lose. Absolutely, Christian. The broker will earn its money either way. The broker will generate their revenue regardless of the outcome of your trade. Jonas, you're asking if you can change a stop loss. Say it's going good. Can I raise my stop loss once it goes good? You can indeed, Jonas. You can edit it. You can change it however often you wish, and it should be at absolutely no cost. Daisy, you're asking, do brokers advise what market to enter? Typically not, Daisy, to be honest with you. Typically not. They're typically not allowed to, that you have to make your own decision. Let me have a look. Nikolai, you're asking if trading is a zero-sum game. No, it's not a zero-sum game, Nikolai, because of those transactional costs, I guess. Let me have a look. Jeff, you're asking with the candlesticks, can we run through the points, the lines that run at the top and bottom of the wick? Yeah, sure, Jeff. They're just the high point and the low point of the market on that specific candlestick. So the top of the body, if you like, if it's a green candlestick, if it's an optimistic candlestick, the top of the body of the candlestick is the close price. The bottom of the body of the candlestick is the open price. The top of the upper wick is the high price, and the bottom of the lower wick is the low price. So it has those four pieces of information. We'll be going through it and showing it a huge amount of times in the future, Jeff. So the body, you're dead right. The body is open and close. The wick is high and low. Okay, no trouble, Steve. Many thanks. Gary's asking if I can see him. Gary, no, I can't see you at all. No, I cannot. I'm not sure if that's a good or a bad thing, Gary, if I'm being completely honest with you. What else have we got? Bavesh, you're asking how come future indices trading wasn't recommended. I don't mind trading the indice market at all, Bavesh. It's a market I like trading. No trouble whatsoever. What else have we got? What have we got? Let me have a look. John, you're saying the online brokers that charge a flat rate per trade, does that mean that they do not charge pips? Typically, I'm going to say yes, John, that they might say that regardless of the size of the trade or regardless of the market that you're looking at, we're just going to charge you X amount. And again, that can be a good thing or a bad thing. It's a bad thing if you want to trade a very small amount because that set rate tends to be quite high if you want to trade a very small trade size, if you like. If you want to trade a very large trade size, it can be in your favor. Autumn, you're asking if there's going to be an email reminder about the third class. I'm fairly confident that there is, Autumn, but I'm not going to just lay my life on it. I'm fairly confident that there is an email making you aware of it. If the support team behind me knows any different, they might type it into the chat box if that's okay. What else have we got? Jeff, you're asking, with leverage trading, can you have multiple stop losses against your deposit? Yeah, Jeff, you can place as many stop losses as you wish. Ramesh, you're asking if it's a good time to invest in oil. I honestly haven't looked at the chart. We'd have to look at it from a technical perspective. Look, why don't we have a look at oil as one of the charts next week? Not only that, I know a lot of people have been asking about the Dow Jones based upon the action of the China over the weekend. So yeah, we'll have a look at the Dow. We'll have a look at oil as well next week. No problem whatsoever. What else have we got? Jeremiah, you're asking, how do the brokers have access to the trades they are giving you access to if they are not loaning you the money for the trades? How do the brokers have access to the trades that they are giving you access to if they are not loaning you the money? I'm not massively sure I understand the question, Jeremiah. I do apologize. I'm not massively sure, but maybe it's because that leverage is a two-way street. The liquidity provider would allow the broker to have access to the trade at that same rate, if you like, and that's why it's in the broker's interest to ensure that you never go negative. That's why it's in the broker's interest to ensure that, in the nicest possible way, that you get kicked out of the trade if your deposit does start to get eaten up, because it's not a credit facility. It's not going to come after you to chase you for any negative balance, if you like. It never wants that to happen. It never wants that to impact on itself. So that's maybe, hopefully that answers the question. If I think I'm understanding your question right. Let me have a look. Eric, you're asking, are you buying a contract based on the speculation the price is going to go up or down? Eric, you always buy on the speculation, on the hope that it's going to rise in value. You buy low, you sell high, and then you sell if you believe the opposite is about to occur. Let me have a look. What else have we got? Shri, you're asking, when do we consider the whole candlestick chart? The whole candlestick chart on the whole, or parts of the chart to decide the trend? That's a great question, Shri. I look, again, not to deflect from it maybe, but we will be looking at Japanese candlestick charts in a huge amount more detail from next week onwards. Mikhail, we will be going through some of those indicators as well. No trouble at all. We'll absolutely be going through moving averages. We'll be going through some oscillators. No trouble whatsoever as we progress. Jeff, as far as the gaps, yeah, I'll be showing you gaps in the market next week and explaining the reasons behind them. No trouble whatsoever. Thank you, Laura, for your kind words. Thank you very much. Let me have a look. Rashida, you're asking, are candlesticks our recommended method of choosing trades? Not of choosing trades, it's a recommended analysis, I guess. It's a recommended analysis. Branca, you're asking, are the candlestick charts widely available? They are indeed. We'll be showing you how to access them. Lesson number 7. Mikhail, many thanks for your kind words. Narendra, you're saying that you keep hearing that folks make money shorting as well. Can you please give a scenario where it would be the case? You mentioned we buy low and sell high for profit. Absolutely, Narendra. And then you can also sell high and buy low for profit. You can sell high and buy low. If we go back to that analogy I was using about a car, if you were to sell a car to somebody if you're like a car dealer, and somebody came to you and they said that they had €20,000 to spend on a 2013 model Ford Mondeo 2-litre diesel station wagon, you could sell them that car without owning it, without buying it. How you would make money in that transaction if you were able to go out and actually source one for less than the agreed figure, less than the sold figure. That's how it works. So I'll be going through it in a bit more detail. Not only a bit, I'll be going through it in a lot more detail from next week onwards. Adam, great stuff. I'm delighted for that. Many, many thanks for your participation. Let me have a look. John, many thanks to you as well. What have we got? What have we got? Yes, Danai, the questions and answers is also part of the recording. No problem whatsoever. Are we pretty much there? I think we might be. Bhavesh, you're asking about allowing our profits to run. That's absolutely important. Giovanni, I certainly hope that we're live. Allowing the profits to run, Bhavesh, yeah, again, it's going to be covering the risk management side of things. Massively important part of trading, to allow your profits to run as far as they can go and to limit your losses. That's what trading is, I suppose, broken down to its core elements, isn't it? Okay, I think we're pretty much done. We'll be going through lot sizes. We'll be going through leverage. We'll be going through margin. We'll be going through the different markets. We'll be going through pips. We'll be going through candlesticks. We'll be going through pretty much all of the scenarios which we have already discussed this evening throughout the remainder of the course. So please don't forget that. Not only will we be going through them, but we'll be going through them in a much more practical sense, which will hopefully merge all this information together. You'll be able to marry this very theoretical class which we have this evening and we had 2 days ago, together with the practical classes which we're hopefully going to see from here on in. So don't forget that. It does get easier from this point onwards, I would hope. I would like to thank you all massively for your time to date, and I certainly look forward to speaking to you all again next week. Do take the time to review the recordings if there is anything that remains confusing. Don't forget that we will be in touch with you throughout this course, by phone if possible, by email certainly, in order to get feedback from you, in order to ask if you have any issues, in order to ensure that you're getting exactly what you had hoped to achieve from this course. Until the next time, Jeff T, many thanks. I can't see your chat. Until the next time, guys, many, many thanks. Enjoy the remainder of the week, what's left of it. I'll be back in the early part of next week. So take care for now. All the best. Bye-bye.
Now, I'm not saying I don't like kids. I like kids. I have fun hanging out with my friends' kids and joking around with them, whatever. They're great. But I do feel like when I talk to my friends that recently had kids, it does seem like they had to give up everything for the kid. And that's very scary. You want to have a depressing conversation? Talk to a couple that just had a kid. Ask them about the last night they went out for themselves. They will describe the most boring, typical, mundane evening out.